11:01 and time to go forward with this. So this week, I'm just going to talk about a couple of stories. Then we're going to hand over to Andrew McHattie, who is there in the picture on the screen. He'll be talking about discounts and share price moves and things. And then our guest this week is Tredget from Oakley Capital, the private equity firm. So that should be quite interesting to find out how it's been faring in the current environment. Apologies, I've been sort of slightly rushed this morning. So I did think about talking about, there's loads of other things going on apart from these two, but obviously a couple of big stories, Perpetual and Murray Income getting together, and JPMorgan Brazil deciding to wind up. I could have also mentioned things, so apparently Gabelli Value Plus voted against continuation yesterday, which is probably unsurprising. I think we talked about this a few weeks ago. What was the other one I was going to mention this morning? Oh yeah, the direct Nimrod funds, the aircraft leasing things. So again, we've talked about those before as well. So they're the ones with the leases of the A380s to Emirates. And they said actually that Emirates has been paying the lease payments, which is good news, I think. But they've had massively slashed the NAVs. They've more or less halved all the NAVs, reflecting the serious situation in the aviation market. Anyway, so pressing on. First off, looking at this combination of Perpetual Income and growth and Murray Income, two names that have been around for a very long time in the investment trust sector, and I suppose Perpetual obviously succumbed to Invesco. Murray was taken over by Aberdeen quite a while ago, but the name survived. As you can see here from the discounts, this is obviously this morning, and things have moved slightly from when this was announced, but Perpetual's still on a 10 discount even after this move. Murray's on a 6.5, which is slightly wider than it was, but it does indicate there's still maybe some capital uplift in there, but we'll talk about the mechanics of that later on. And the reason for this is fairly straightforward, as we know. So Mark Barnett underperformed for very many years. The board finally decided that this wasn't tenable anymore, and decided to replace him. They gave notice to Invesco, and then went out looking for a partner. And we were quite keen that they thought about the idea of a merger. But as much as we jump up and down about these things, it's very rare that one actually happens. And so we're extremely pleased that this has come over the hill. And actually, we think it's probably a great idea. You can see the difference in the performance numbers there. It's a massive table from the year before. But basically, any time period you think of, Perpetual's at the bottom end of the league table, and Murray Income's near the top. So from that point of view, you've got to be thinking this is good news. The mechanics of this, it's a slightly complicated thing. The Section 110 scheme of the Companies Act basically means that Perpetual ended up getting liquidated and taken over by Murray, but it doesn't work that way from a tax point of view. It's also a nice, smooth arrangement. It's based on formula asset values, so basically the costs of doing the transaction will be taken into account, and then you'll get Perpetual shares in exchange for Murray shares based on the respective differential in the asset values, which is roughly about 0.3 Murray shares for every Perpetual share. You also get the chance, if you want to, of taking a cash exit from Perpetual, but that'll be at a 2% discount to that formula asset value, which really is, trying to discourage you from doing that a little bit. You'd still actually get a slight uplift on doing that rather than running to Murray and then selling Murray shares. But I'd imagine that most people that hold Perpetual actually want to be invested in the UK Equity Income Fund and weren't in there just for hope of a discount narrowing. So I think most people won't run for the exit. We'll wait and see. Before this started, as I say there, Perpetual was trading on a 15 discount and a 6.9% yield, and the Murray Fund was trading at 4.9% discount, 4.5% yield. So the combination of doing this based on formula asset values mean that you get a capital uplift for Perpetual which is assuming money goes back to trading at roughly where it was, and that is more or less how its sort of long-run discount level. You get a couple of uplift from that, but you also take an income hit because the yield on marine income's portfolio is lower than the perpetual one. And the argument's been put forward there that actually the yield on the marine income portfolio is much more sustainable than the one on perpetual. Perpetual was struggling to keep yield, and that was one of the reasons why it was suffering in performance terms. And I think I buy that argument. The combination creates a fund that's going to be £1 billion market cap, hopefully. I think that means you get a new champion in the equity income sector. At a time when we've been pushing, the AIC, all sorts of journalists have been trying to push the message to investors that if you want an income stream and you want that income stream to be predictable, you're much better off in an investment company that can sort money away for a rainy day and then release it in times like now when that income is disappearing. You get that smooth income profile, and it's more of a sort of sleep at night thing if you're relying on that income. And there's been examples in the press of investors that are generally worried about losing the income from their open-ended funds. We think if that argument starts to seep through, you could see an awful lot of money switching, because the UK open-ended UK income sector is a multiple of the size of the closed-end one, and that could drive discounts down. That's our hope. So I should say, because I worked it out, but I think very roughly, based on the numbers that I had there, the capital uplift from doing the deal for perpetual shareholders is worth about 4 times more than the income that they're going to lose on an annual basis. So actually, it still kind of like works out the wash. So there we go. Good news, we think. JPMorgan Brazil is a fund that's been around for 10 years now. It's really just past its 10-year anniversary, and it hasn't covered itself in glory, as you can see from these sort of numbers here. Still trading at discount, even after they've said they don't know what keep it going. And the performance numbers, although you actually got a decent 5-year NAV number there, that's just reflective of how volatile that Brazilian market's been. And actually, over 10 years, you've lost money. And there it is graphically, with the share price in blue and the NAV in green. And you can see that the discount has been wider than it was, but they're in the middle bit. But still, it's after an initial period where it didn't do too badly, it's a general downward trend, and then a more stable since about 2016. The whole rationale for launching the fund back in 2010 was really the enthusiasm about investing in BRICS, the Brazil, Russia, India, China, South Africa, which had been sort of popularized in the early 90s and then became a real thing in 2009-10. But even with this enthusiasm behind it, it didn't raise an awful lot of money just in the launch, so less than 50 million, which I think was sort of reckoned to be a failure, really. I think they would have wanted at least 50. It was came with some subscription shares on a 1-for-5 basis. That would have helped to expand the fund down the line had they been exercised, but actually they finished up underwater. And as I said earlier on, it was trading at a premium to start off with, and it was issuing stock, but that ran out of steam after a year or so. It wasn't designed to be replicate the Brazilian market perfectly. There was a sort of conscious decision to avoid the kind of big state-owned enterprises and some of the really big kind of commodity players. So things like Petrobras and Vale. And because of that, as I explained in a second, they chose a different benchmark on the MSCI Brazil. And also because it was trying to be good in corporate governance terms, it came with a semi-annual tender offer. And of course, as soon as things started to go wrong, that means that the fund started to shrink, and eventually they had to abandon that idea. But you can see why it was launched. in this chart that I've lifted from a NUMIS report from 2010 there, which basically shows you that Brazil was doing great. And it was one of those classic things where after a long run period of an asset class performing, everybody goes, it wouldn't it be great to have something dedicated to the area? They launch it and then it all rolls over. Probably don't need to look at that, but this is just explaining the difference in returns between Brazil and JPMorgan's benchmark, which is the MSCI Brazil 1040. And the idea of that is that you take the MSCI index, which is skewed towards a handful of very large companies, and you basically cap the maximum percentage of any particular stock at 10%, and the maximum percentage of any particular sector at 40%, and that gives you a more realistic thing of what you could construct a portfolio at without having too skewed risks within the portfolio. And people use it in other markets like Russia, for example. But actually, having chosen the 1040 index, it turned out to be a tougher benchmark to meet than the normal one. So it was great to start off with. The momentum was building in Brazil, World Cup was coming, Olympics was coming. And it was one of those classic things of like the company holds the Olympics and then immediately goes into recession afterwards because they've pulled forward huge amounts of infrastructure spending. And it more or less works exactly right. And then there was this sort of political infighting, corruption allegations. But one of the big things that hit Brazil was the slumping commodity markets. And so oil prices, iron ore prices. And that was the thing that hit things like Petrobras and Vale. And it's not really recovered, although, as I said, there's been a sort of seesaw. There was a continuation vote in the 2018 AGM, but the board said at the time, we know that the trust isn't doing too well, and at that time it was 20% behind the benchmark. But actually, recent performance has been much better. We think it's all changing. It's all going to be wonderful. So why don't you just approve this now, and we'll give you another vote in September 2020. Well, things weren't going too bad, and then COVID came along, and Brazil, as we know, has been one of the worst affected places by this. What I've pulled out here is a selection of indices. They're all MSCI indices. It's either the Global Airlines Index or Global Energy Index or the individual country funds. And you can see, obviously, airlines, oil, they're the sorts of things being hit quite bad. But on the country scale, Brazil is by far the biggest casualty. Greece, Sri Lanka, Bahrain, Brazil. It's not been doing very well at all. And that has really crystallized the board's decision to say, let's give up now, let's vote against continuation. I very much think that that's going to be the way things go, even though the performance seems to be putting ahead of it now. I can't see shareholders going, no, we really want this fund. So, on that note, I will shut up for a bit and hand over to Andrew, and he's going to now share his screen with us.
Lovely, thank you very much indeed, James. I'll just switch over. That was great. I had no idea there was such a thing as an S110 scheme before, so that's great to know. Yeah, JPMorgan Brazil is an interesting one. I spoke about it last month, how difficult it was to deal in those shares. And actually, they do appear on the list of biggest risers this month, somewhere near the bottom there, which is obviously because they're likely to wind up. As always, there's quite a mix of things on here. I was just thinking back, actually, to when I started the Investment Trust newsletter in 1996, and having a discussion with my co-founder at the time, Lawrence Lever, who suggested it. And I wondered whether there would be sufficient news and movement and interest every month to justify a regular newsletter. And I've since discovered there's plenty going on all the time. So it's quite a lot of movement here. I've just highlighted at the top a couple of the trusts that have been subject to corporate action that you spoke about last week, James. Obviously, both of those have received bids and had quite a significant uplift as a result. Amongst all of the mix here, though, I think there was one theme that really jumped out to me, and that's that the resources trusts have had a cracking month. All 5 of the major trusts here appear on the list of risers to one extent or another, topped by Golden Prospects Precious Metals as a trust managed by CQS. It's not that well known, but it's obviously done extremely well this month because of the huge acceleration in the gold price, which has risen really dramatically over the last year. And you can see from this chart that it's accelerated enormously in the last month or so. Principally, I think, due to renewed concerns over COVID, but there's a lot going on. And it's easy, I think, to make a bull case for gold. In some ways, it is a perfect storm. Obviously, gold is used as a haven in times of trouble, when people are worried about the security of their assets and striving to get some kind of positive return, or at least stop losing money. And this period here, where we're unsure about what's going to happen next with the pandemic, and there's potential for a really deep global recession coming, that's a very fine backdrop for gold. And it's backed up really by a couple of more specific macro elements. One is that interest rates are very likely to remain low for an extended period. And that helps gold because, of course, gold doesn't yield anything. So if you're comparing it to government bonds and other things that will pay you a coupon, then the fact that interest rates are going to be 0 or certainly very low for an extended period increases the relative attraction of gold. So it's reducing the opportunity cost of holding it. The weakening US dollar has been quite a big factor in the last week in particular. I mean, you may have noticed that sterling against the dollar has risen to about 131, which is not very helpful if you're holding dollar-denominated investment trusts. But that's not because sterling is in demand, it's because the dollar has been weak. And of course, ahead of the US presidential election in November, and Trump making all sorts of noises now about this uncertainty about the election and the unreliability of postal votes, he's obviously positioning himself to make a fuss if he loses. So there's going to be quite a lot of nerves, I suspect, around the US dollar over the next few months. And that again helps the demand for gold. The last bullet point there is about future inflation. And with governments around the world planning to reflate their economies mightily with a lot of monetary expansion and spending on infrastructure and the like over the coming months, there is scope for much more inflation in the system. And gold is traditionally a hedge against inflation. Actually, if you look at the data, it doesn't work that well as a hedge against inflation, but it's considered a hedge against inflation, and therefore that's part of the demand. Gold's a funny market in that it does have a lot of gold bulls who love to talk it up. And I think you have to be a bit wary of just extrapolating what's happened recently. Clearly, this has been a big spike in the price. It may continue, but it's not in a straight line for sure. Goldman Sachs have just raised their 12-month price forecast on gold to $2,300 an ounce. So there are some fairly sober names suggesting this could continue. If you're looking for an investment trust to be exposed to gold, amongst those 5 that were highlighted in the list of risers, they have varying exposure. I've just taken the data from the last fact sheets I could find. So for BlackRock Energy and Resources Income, as you would expect, because it's much more exposed to energy and also seeking a yield, it doesn't have that much in gold. It was 16% at the last fact sheet. Baker Steel Resources Trust, a bit more. CQS Natural Resources, 24%. BlackRock World Mining, which is the obvious choice in the sector really, because it's by far the largest and most liquid of these trusts. The others are fairly small. at the end of May, it had 33% of its portfolio directly exposed to gold. And you would think that would have risen since then because of the performance. So there's quite a large chunk. And I'm not sure that's widely recognized, because I think many people would anticipate that this would be a cyclical play which would be suffering in the face of a global downturn. But effectively, the portfolio is internally hedged against itself, because it has the industrial metals that might well benefit from future infrastructure spending, but it has the gold as well. So it's quite an interesting combination there, worth thinking about. And the final one, Golden Prospect Precious Metals, as the name implies, it's much more directly invested here, 75% in gold, but it also had a chunk in silver, which does tend to move in a correlated fashion. So actually that is the one to have if you are specifically seeking a position on gold. The shares were up 46% over the last month. It is one of the few trusts as well still to have subscription shares, not for much longer, but for a little bit, another few months. And those did more than triple in value over the last month. Obviously, you need to be careful with those and check the terms before you deal and be aware of the leverage, but they're interesting. More broadly, in terms of the value in the sector and the discounts that are currently available, they're not bad. They have come in a little bit. They are narrower. If you look at the Z scores against the 12-month average discount, these have all come in a bit, but they're all available on a discount. BlackRock World Mining there is a 10.7 discount, and you're also getting a yield of 5.3%. So I think there is some value there. Baker Steel Resources Trust is the widest discount at 21.6%. So I think that's quite interesting. If you don't have commodities exposure in your portfolio and you were wary of it because of the cyclical nature of many of the returns, just be aware of the gold element. I think this really speaks to me more broadly about what's happening in the sector as well. That for a few months now, really since the start of the pandemic, if you had plenty of exposure to technology and biotech, healthcare, you were set fair. Those were far and away the leading sectors. And although we had very good results last night in the US from the big four tech stocks that should support that sector, I think, for a while longer, I sense now that investors are looking beyond those, and they're seeking out other things. And we're starting to see a bit more interest in some of the unloved sectors, such as real estate, and there was one real estate trust on that list of risers. I suspect we might see some more. And I've been looking at that and finding some really interesting investment trusts there that I think have been ignored, and people have shoved them to the side because they're a bit too worried about the broad outlook for real estate in the UK and retail especially. But actually there are some good portfolios that shouldn't be too affected. Obviously, Quoted Data have done quite a lot of work on that lately with their property seminars. Private equity is another sector that, again, was hit hard in the initial slump and hasn't really bounced back too strongly, but there were two private equity trusts on that list of risers this month. And Oakley Capital is obviously an interesting one on a big discount. So we'll look forward to hearing what Stephen has to say there. UK smaller companies as well. River and Mercantile Microcap was on the list of risers, but it's still on a very big discount. And there's a lot of value in that sector if you're prepared to take the plunge and you think that the UK economy can recover in reasonable time. So I think there's quite a lot of value around that people are now starting to think about. They're starting to sift through some of these other places, having benefited just from being in those in the tech and healthcare sectors previously. And the corporate activity that we're seeing, obviously James has just spoken about that, really speaks to the same trend. There was a note from Numis actually in mid-July, just before all of this corporate activity, to their credit, which spoke of the potential gains to be made from combining investment companies and also taking some out. And I think this hunt for undervalued assets and a bit more focus on trusts where they've really had their ratings squashed by negative sentiment is likely to continue. I'm not making a forecast, but it wouldn't surprise me at all if we saw a bit more property and private equity on the list of rises next month. So I think we're just seeing a development of the market trend here and a shift somewhat away from those sectors that have been leading up till now. Okay, that's it from me. So I'll hand you back to James, and we'll have a chat with Stephen.
Oh, thank you, Andrew. I'll just share my screen again. Yeah, no, actually, I thought that was all quite interesting. So there's obviously a lot going on, and there's definitely the commodity stuff. Yeah, but obviously the main subject now is private equity, and here, as you say, the discounts are huge. So according to quoted data's numbers this morning, Oakley's on a 36 discount. Obviously, the NAV is maybe slightly out of date, and we soon talk about that a bit. But to me, all of these private equity things look like real bargains. So let's see if Stephen can convince us of that too. So are you there, Stephen, able to talk to us?
I am. Good morning, James, and thank you very much for having me on this morning.
And thank you for joining us. No, it's going to be interesting, I think. So can you say a little bit first about Oakley and how it's set up and how long the fund's been going for, the sort of just the basic stuff, please?
Yeah, of course. So Oakley Capital Investments is the listed vehicle. It was listed on AIM back in 2007, and its primary objective was to invest in the funds managed by Oakley Capital. And that's essentially what it's done. That initial capital was committed to Fund 1. As Fund 1 invested, it was drawn down. As assets are sold, the cash flows back into OCI and it invests into the next fund and so on. And Oakley's at Fund 4 now and has just released a new fund, the Origin Fund. And I guess essentially as any listed PE, it kind of gives public market investors like ourselves the opportunity to kind of get access to high quality private companies. And the appeal is that those funds since inception have delivered a net 25% IRR. So kind of highly desirable. And essentially it's a good proxy for that. The only drag to that is essentially you have to retain cash in the NAV in order to kind of meet the future commitments.
Yeah, okay. So, so as you say, so it's a series of funds. Is there anything left of Oakley One in the trust now, or is that all being wound up?
Only Time Out,
Okay.
which as you'll know is listed. I suspect from an OCI perspective, an Oakley perspective, as Time Out gets bigger, more liquid, obviously getting past this particular COVID issues, then there's the opportunity for kind of Oakley to slowly exit kind of Time Out.
So we've got a slide that actually shows your portfolio. So we should have a look at that now. Which this is great actually, and you can see Time Out there in the bottom right-hand corner, almost 50 billion quid, one of your bigger positions. So can you, so this first, can you sort of talk about the split of it by sector? These are the sort of things that you focus on?
Yeah, absolutely. So the three sectors, as you can see on the screen, technology, education, and consumer. And aside from kind of Time Out and North Sales and the Brand Co, it's a very kind of digital consumer type bias, and kind of broadly spread across those three sectors. I guess if you had to choose some common characteristics across those 15 companies, you tend to find that we typically back market leaders in a particularly attractive niche. It's very easy. It's much easier to hold and dominate a market position rather than try to grow into one. The vast majority of them are kind of deliver tech-enabled services or are on a digital platform, an online platform. And in the majority of cases, I think probably something like 65% of those companies has some kind of subscription revenue. So there's really good high revenue visibility. And I guess those traits, I'm sure we'll talk about this a lot more, have proven to be the reasons why the portfolio has been pretty resilient over the last 6 months.
Cool. And then it might be just sort of instructive to talk about an individual investment. I don't know which one you probably thought, I know I'll talk about this one, but I was going to ask you about Daisy, because I think from my memory, that's been in the portfolio for a very long time. And you've actually made quite a lot of money out of that already.
Yeah, it has. I guess you could pick anyone there and they'd be reasonably typical of how we do a deal. Because I guess the key characteristics of an Oakley deal, the manager and the way they approach things, is that Oakley was founded by an entrepreneur, a gentleman called Peter Dubens, who remains a senior partner as one of 7 partners at Oakley. And his background as an entrepreneur is that he wanted to kind of create the kind of financial partner that he never had when he was kind of creating businesses. And consequently, when he started Oakley, he really wanted to focus on business founders and entrepreneurs and forming genuine partnerships. Now, it's a much overused term, kind of partnerships and operating partners within Oakley, within private equity. But I think that's really remained the DNA of Oakley and its unique kind of selling point. And as a consequence, the origination, the unique origination of Oakley is that it's constant repeat partnerships with business founders, and business founders that appreciate the way we operate to the extent that once they've had a successful investment with us, they tend to not only go on to do other investments, but they invest money themselves into the fund. So of the monies that we managed through the Oakley funds, about 150 million euros of that has actually been committed by the business founders that we've backed. And one of those business founders is Matthew Riley, who has been an incredibly successful telco entrepreneur, still continues to be. And Daisy was a great example of that. We invested back in 2010, I think, originally, and essentially, exactly that, forging a relationship with a really talented business founder who needed a partner to help him to continue to do a buy and build operation with his telecoms business. Which is now, thanks to that kind of buy and build, and we've been on the public markets and off the public markets, it's now the largest small to medium size independent business telco in the UK. I mean, now, as I say, it's now private. We have a small residual holding. It's probably that telecoms investment in Daisy, as is often the case, kind of led us particularly into web hosting. And then our experience of web hosting has led us into web hosting software with Web Pros. And then that has led us into more business service software, which we found to be a particularly strong niche, and one I think that will really be the key trend for us within the technology environment.
I think this is very interesting because it sort of rams home this message because I think there's a public perception that private equity firms sort of rape and pillage companies and buy the company, strip the assets out, gear it up, set it on. But this is complete antithesis of this. This is actually building businesses from scratch.
Yeah, I agree. I mean, it's one of it unfortunately is a really tarnished term, isn't it? Private equity. I mean, essentially, it is just investing in private companies, and it can take all kinds of forms. And I'm sure there are, the old vestiges of the vulture private equity, I'm sure exists somewhere. But we're talking about kind of mid markets. You're looking to invest and grow and develop businesses and build businesses. To that point. We're often, in 90% of the cases, we're often the first PE investor into a company. So this isn't these aren't assets that have been kicked around the kind of private equity world before we get our hands on them. And I think really importantly, the managers we back, in 95% of cases, they are the managers that we finish an investment with, which I think speaks to the fact that if you're developing a company, nurturing it, if you're actually, a good partner to a business and actually choose your management well, they should be there at the end. Remarkably, I think the stat within private equity is actually that in 50% of cases, the management have changed by the end of the investment period. Sorry, and that's the kind of the CEO of the business.
Yeah, okay.
It's completely different to the view that people I think typically have of private equity.
Can you talk a little bit more about Time Out? It's just because it's a name I think that most people know, but they might not really know what the business does now. Because all I remember is sort of the magazine that was we used to pay for, and then it got given away free at the Tube.
Yeah, that was. So 1968, that magazine was first published in London. And sadly, actually, the founder of that business, Tony Elliott, who made that first fact sheet back in 1968, passed away last week.
Oh.
But his vision was really, it's still the vision to this day of that business, which is to basically, kind of hold the hand of people in a city and show them the best things to do, whether that's kind of, food and drink, theatre, art, culture. What has dramatically changed is what went from a magazine then became really about digital channels. So the magazine Tops had kind of an audience of maybe 10 million globally. And it went from a few cities to now 300, over 300, nearly 350 cities. But as a result of going digital, the company now attracts something like a 60 million audience a month. And what Oakley set out to do in acquiring Time Out was, one, bring it into the digital age, which it successfully did and grew the audience and grew digital advertising as a result. But what he got really lucky was that in 2014, Time Out Portugal launched in Lisbon a food and beverage market, which was essentially the physical version of Time Out. So the best food from local restaurants in all the kind of key categories. And it was an enormous, and still is, kind of an enormous success. To the extent that it's now the most visited tourist attraction in Portugal. 4 million people a year visit that market in Lisbon. And so successful was the format that our key strategy in Time Out has been rolling out those markets globally. So we opened 5 last year. And actually, we had a tremendous year last year, as was demonstrated by the share price. We entered into this year with 6 of those markets open. I mean, they're incredibly lucrative. I mean, Lisbon generated something like 6 million euros of EBITDA alone, that market, last year. Compare that to the market cap of Time Out today, which is something more like 80, 90 million pounds. And so we had those open. The media business was turning profitable again. And then, unfortunately, COVID struck. But it's been refinanced. You've seen the shares come down as a result of a kind of deeply discounted refinancing that actually OCI's debt to the company was repaid. And now it's kind of set fair to kind of get its way through the COVID experience. It's got enough cash, regardless of what happens, to get it to the end of 2021. But it's interesting you raise it, because here in the UK it's a really well-known brand. It's a loved brand. We may have had some of us may not have interacted with it directly for many years. I mean, I used to be a subscriber of the magazine, but I think probably, even though it's only 7% of the NAV today, and really not a typical investment for us. The companies that we're investing in now are probably much more established. We're not trying to change the direction of the business or bring in particularly new strategies. They are definitely profitable and kind of, typically, these businesses certainly last year would have been growing the EBITDA an average of 30%. So not the kind of investment that, that maybe someone like Time Out represents. But still, it is still it will prove to be a great opportunity for us. It's just unfortunately it's going to take a year or so to emerge from the pandemic restrictions.
Oh, okay. Actually, I suppose we should talk about COVID. I think there's another slide on that as well, isn't there? So let's try.
Yeah, well, let's go through those 2 slides if that works for you.
First, and then go back to the other one.
Yeah, fine. Okay. So yeah, we had our trading update out on Wednesday, and an attempt to kind of guide people through how we are faring in this particular environment and which companies are kind of prospering and those that are being hit. And we divided our 15 portfolios up into three kind of distinct buckets. What's kind of notable is the first two buckets really is essentially our technology investments, education investments, and digital consumer investments. And five of those companies have not experienced a trading impact at all. In fact, some have benefited from the current environment. And they are, kind of business service software, web hosting, education technology, and CPG is a great example of that. That's an online higher education university, or certainly that is its biggest growing business. And as you could imagine, that's been incredibly popular during this period. I think student numbers or student sign-ups have more than doubled, so record-breaking sign-ups for what was already a particularly successful business. And also, as you imagine, there's still a lot of people, international students, that aspire to have a European degree, but are now either don't want to or can't, come over here to get their degree or start their education in September. So Career Partner's been a great beneficiary of that. I won't go through them in case-by-case detail, but other than to say that particular group has obviously performed well. Notably, so the NAV in the last 6 months grew by 4%, which I think is reasonably, it's a resilient performance. That's total NAV return. So it grew by 11 pence, and there was a 2.25 pence divvy paid in that period. So pretty resilient. Now, I would say of those 5 companies that I've identified as having no impact or benefit in this period, 4 of them were purchased in the last 12 months. And so consequently, they're being still held at cost. So despite some of these businesses actually traveling quite well, you won't have actually necessarily see the positive impact of that in the NAV at this stage. Then the middle bucket there is 7 of those companies that have experienced some kind of short-term disruption. And they are the kind of online consumer platforms. I'll talk a little about those in a second, but that's Perpetual and Casa, telecoms like Daisy, and education businesses. And in those cases, there's been disruption, which you would imagine. Let's take Perpetual as an example. That is an online price comparison website, a money supermarket of Italy, the number 1 player in that space. And we purchased it because a few years ago now, with the premise that kind of actually across the board digital online platforms have had lower penetration in Italy at this point. To give an example, car insurance online in price comparison websites accounts for like 70% of car insurance. In Italy, it's 12%. Now, as you can imagine, the current environment has really led to a greater penetration of models like that. I mean, Amazon, who was barely penetrated in Italy, had an incredible, first month that was apparently equal to their entire year the year before in Italy. Now, Facile would have had some disruption because actually in Italy, for example, you didn't have to reinsure or tax or MOT your car during the months of lockdown. So actually there would have been fewer inquiries or business done, but those that were done in Italy, more than were done online. So there's a great example where there's been a level of short-term disruption, but actually in the fullness of the year, we expect these businesses to return or get close to their budget. So you certainly wouldn't have seen, we couldn't have justified necessary fair value uplifts as a result of that, and some of them may have come down by a small amount, but our confidence about where they're finishing the full year is still pretty much in place. And then I guess the third column, which is the one where there is a lot of focus because it's clearly where risk lies, is in consumer stocks. And these are the 3 companies, Time Out, North South, and the Iconic Brand Co., which has bought 2 businesses on that platform today, Alessi and Globetrotter. And this is a category where there is some kind of physical footprint, a direct consumer model, and it's clearly, as a result of lockdown, had significant impact. I guess what has been, and that's obviously demonstrated in time at share price, I guess what's been particularly encouraging to us is that in June, July, particularly in North and the iconic brand co, there's been a real surge in activity. I mean, no idea if that's maintainable. And of course, I think a lot of people expect a certain amount of continued disruption kind of globally as a result of the pandemic. But a real sign of strength. And in fact, in many cases, the trading has been above the level we'd anticipated last year. And of course, in both those cases, the online retail has been incredibly strong. And I'm sure that will be the case for a lot of consumer companies, that they're now biased towards their online channels, which have really been boosted as a result of this.
Yeah, cool. It's encouraging stuff, really. So the slide we missed out was this one, which is basically where the portfolio stands.
Yeah, it's kind of saying, you know, particularly if you buy a share in OCI, you obviously get a look through to 15 portfolio companies. And we try to give some average stats about those portfolio companies. So on average, over the last 12 months, they've grown their EBITDA at 17.5%. Now, that's clearly been impacted significantly as a result of the last 6 months, but average EBITDA still grew in that period. I think the other thing that attracts a lot of attention, particularly in the private equity world, is how much debt is deployed. And the average net debt to EBITDA in the companies is 3.5 times. Now that I accept from a public market standpoint is maybe high. You wouldn't see maybe net debt to EBITDAs really look to go much beyond 2 or 2.5 times. But in the private equity universe, the average is something more like 6 to 7 times net debt to EBITDA. So debt is really not the feature of how we drive our returns. And to give you a sense of how comfortable we are with that kind of coverage, a lot of the businesses we're talking about, digital businesses, relatively low capex, a lot of the EBITDA, we've got high conversion to cash. So our ability to kind of, you know, maintain multiples like that is pretty easy. And then finally, to give you a sense of what the average valuation of the companies is that they're sitting on average 11.8 times EV/EBITDA. Now, when you consider the quality of the businesses, and we're talking about those kind of tech-enabled services or digital platforms or subscription-based services, then for that quality, that valuation seems reasonably modest. I guess there's one other feature which we should mention, not necessarily the portfolio companies, but as a result of the sale in assets in the first half, Oakley, OCI received 290 odd million of proceeds. So one of the features of the near 700 million of net asset value today is that 260 odd million pounds of that sits in cash. So £1.34 of the £2.20 odd share price is currently in cash, which would, I accept, wouldn't be an ideal situation. In a normal environment, that would be a massive handbrake on performance. Yeah. But at this particular point in time, with the potential investment opportunities that may present themselves as a result of the disruption around the world, that's an incredibly fortuitous and lucky position to be in. And actually, you know, one, it makes our NAV incredibly robust, if that's one of your concerns about, you know, investing in any investment trust at this point in time, at this point in the cycle. And if you're very conservative about, or very, you know, fearful about the economy from here, well, you know, sitting with that percentage of your share price in cash is obviously a good position to be in. On a positive note, if you think there's a really, you know, these tend to prove to be great vintages for investment trusts that, you know, who have a vintage that starts after, you know, some kind of economic disruption. They tend to be the best performing. Yeah. And that puts us in an incredibly good position as far as the funds and Fund 4 of Oakley is only 30% deployed. As it obviously now looks to deploy capital, then we're in a very good position to be able to support to be able to meet our commitments as the funds draw down.
Yeah, good. Well, that's great. Good story, as I say, and I think, as I said before, this is silly cheap. But I'm allowed to say that and see maybe would be biased. So thanks very much, everybody, for all of this. I know we've gone on wild this today, but let's see if we've got some questions now. How we do this? So what I've got here is why is a listed holding such as Time Out in the portfolio? So why would you hold a listed holding in a private?
Yeah, it's a really good question, and it's not really by design. It was a private company that we purchased, and that Fund One had come to the end of its life, and Time Out needed further capital, particularly to develop the market strategy. And so our option was you could sell it out of Fund One. You could go and find another PE partner, but they then may or may not agree with your particular approach, or because we had such strong relationships with the public markets, we listed. So it's very peculiar to Time Out. We still hold across the funds and Time Out, kind of 50% of the company. So it's kind of quasi-listed, I would suggest. But we certainly wouldn't look to repeat that as a strategy.
Fair enough. By all means, anybody who wants to ask questions, just chuck them in the Q&A. But I've got a couple online as well. What's the sort of average uplift that you get when you sell something?
Since inception, the average uplift is about 34%. So that's the carrying value at the time.
Yeah.
So arguably you sit on arguably there's a double discount because you got the NAV currently trading at a 37% discount to fair value, and then when we sell an asset, we sell that at a premium on average at 34% to that premium to that fair value.
Yeah, exactly. Which ought to be attractive. One just popped up here. Internal rates of return is sort of like the favoured performance measure that you hear bandied around by private equity companies. I suppose the question is implying that you can manipulate those or just quote them out of context. Do you think that's fair?
Well, I think in any accounting, financial reporting, there is obvious opportunity to manipulate. I guess what matters most from an Oakley Capital Investments perspective is how your NAV grows. And so
well, investors will probably see how the share price does. But
either your NAV grows or it doesn't. I think in terms of the IRR, it's reasonably straightforward in that that is based entirely upon assets that you've exited, and you receive a certain amount of capital for that, and report accordingly. I think what is the more reliable metric and the most relevant metric for OCI shareholders is at what percentage does the NAV grow? That can't be manipulated, and we've proven that the NAV is conservative. I think that the number we quoted yesterday is that the 10-year total NAV return is like 156%, 57%. And I think what's kind of interesting, if you look at our NAV performance, it's really started as the funds have kind of developed, our strategies have developed. The last 5 years, you've seen kind of maturing of the funds and a maturing of that strategy, and that's really shown in the NAV performance. The NAV last year was up 25%. And I think quoted data had it as one of the kind of top 10 performing investment companies last year, in certain periods.
Yeah. Cool. And one of the other sort of things that people love at private equity is that it's quite expensive from a fees point of view. Can you explain a bit about how your fee works?
Yeah, I would say that the thing that optically should make you have the highest fees if you are a good performing listed PE firm is that you should have high performance fees. Clearly, if you're doing well and you're paying performance fees, and the fees will look optically high on that basis. They're not the fixed fee elements, and so the best performing funds have the highest fees. So HG and us, I think one other probably have will look optically like the highest fees because we perform so well. In terms of why does private equity, still able to or justifies charging kind of 2% management fees and 20% performance fees versus what you pay maybe for a publicly listed equity trust, is that it's the level of work and intensity and the efforts behind some of the investments we made. That could be due diligence, and preparation that we'd have been in doing for like 4 or 5 years potentially before an investment's made. And then in terms of how active we are, we're a majority holder, a permanent insider in those companies. We're sitting on the board. We probably have a team of 5 investment professionals that will be dedicated to a particular company. And you are, you're not just sitting on the sidelines. Potentially we'll put people with inside the business, not just on the board. You're daily and helping to work on kind of strategy, bringing expertise to the company and to the board. It's a much more hands-on, day-to-day role than in most other kind of investment trust type vehicles, and particularly in public market, where there really isn't that level of same engagement. There really isn't that same cost to due diligence and company, and then continuing to kind of managing them thereafter.
Okay. I can probably answer this next question. So basically, the question is saying, is there such a thing as sort of like a core investment in private equity where a retail investor can buy one fund and get access to everything? I don't know if you disagree with this, Stephen, but I would say that I wouldn't put you in that camp, because there are trusts out there that invest in funds and they have a big spread of underlying investments. But it can mean that they don't perform as well. So if you think about the big standard private equities, Pantheons, Harbour Vests, they give you that sort of broad spread of investments, whereas an Oakley or an HG is a more concentrated portfolio. Do you agree with that?
Look, it's a spot on summary. I would, as to your preference, it really does. There's clearly going to be, with a less diversified portfolio, with, in this case, kind of 15 companies, there's going to be a greater level of risk with that, but in return, you get a greater level of returns. And to your point, there are some great businesses, great fund of funds like Harbour Vest and Pantheon, who are, are invested across thousands of private equity companies via tens of private equity funds, and so as a result, you'll get the performance and risk will reflect that. Now, my personal view is you have the opportunity to back your manager with a small number of listed PE, and the ones that have thrived and survived, I personally would be very happy to back. I mean, actually, since there's obviously been a cull of the performers that have either put too much debt into these businesses or haven't performed well, and now taking those out, I had to say, although small, the listed PE sector is a really high quality one.
Yeah, I agree.
I would happily and have happily invested, across that list, and the direct ones, I guess, which are kind of like Apax, Princess, HG. I think the average discount there is about 15%, so actually lower on average with the kind of direct PE. And look, Oakley sits as an outlier. I'm sure we're relatively the least known of those.
Yeah.
And we have a relatively small kind of private investor following at this stage, probably compared to the others. And I think that's probably another key in kind of developing a valuation. Plus, I suspect we're slightly more known for some of those consumer investments when they are a relatively small percentage of the NAV.
Yeah. Good. All right, that's the lot. So thank you very much indeed, Stephen, and thank you, Andrew, too. So we shall wrap up there. The property seminars are finished, so nothing to report there. We'll be obviously back next week, and do your normal weekly show with news and stuff. Until then, have a good week, and I'll see you soon.